Welcome, everyone. My name is Heather Gallenbeck, and I'm a member of the Kellogg Alumni Relations team. On behalf of the Kellogg School of Management, thank you for joining us. Today's presentation will last 60 minutes. Dean Francesca Cornelli and our distinguished alumnus, Bernard Dallé, will open with a conversation and will address select audience questions throughout the discussion. We encourage you to submit your questions at any time during the program by using the Q&A icon located at the bottom of your screen. And finally, this webinar is being recorded and will be made available on Kellogg's YouTube channel. With that, I will now turn it over to Dean Cornelli to begin our conversation.
Hello, everybody, and welcome to our conversation with distinguished alumni. I've heard from a lot of you, and you're really enjoying seeing what amazing alumni Kellogg has everywhere. So it's so broad, the range both geographically and in terms of industries. And therefore, I'm delighted today to welcome another of our amazing alums, and it's Bernard Dallé joining us from London. Bernard is a partner at Index Ventures and is responsible of all aspects of operation. And he joined Index in 1997, and until 2013 he focused on technology investments. And I was looking at the list of his realized investment, and is so long that is incredibly impressive. But just to mention a few of them, Mimecast, who is now listed on NASDAQ, Gluster is now Red Hat, Pentaho is now Hitachi Data System, and this is just picking a very few. So an incredible career, and I met him before arriving in Evanston, because we were both in London when I was named as a dean. So he was one of the very first alums I met, and it was a pleasure to meet him and see his passion for Kellogg, but also his passion for entrepreneurship and for talking to the student and making Kellogg a destination for entrepreneurship. So I actually also delighted to announce that he very, very recently accepted to be on the global advisory board of Kellogg. And I hope, together, Kellogg is already a great place for entrepreneurship, but we're going to move it even forward. So welcome, Bernard, today.
Thank you, Francesca. I'm very glad to participate to this, and looking forward to many questions, I hope, that are going to come from the audience.
Yes, absolutely. And so, by the way, keep putting the question in the Q&A, and I will weave them in with other question I have for Bernard as you come in. Now, let me start with a question. These days, I always start my question with something about the pandemics, given that we are still in the middle of it, and it's changed things so much. Now, so about all this innovation that we've seen, right, during the beginning of the pandemics, is there something that particularly surprised you, or what are the most innovative sectors? What is happening?
Yeah, crazy times indeed. I would say first and foremost that, in my 20 plus years in this business, what I've come to realize is that innovation never stops. Whether it was when the bubble burst, 2000, or the global financial crisis, or now this very unexpected period that we've gone through, innovation never sleeps. So, yes, you could point to certain innovations that you could draw some kind of sources of it from the pandemic, but the reality is the underlying trends are generally there before the pandemic. What I can see is, look, certain sectors have been accelerated by what happened. Areas like we've seen a lot of innovation in convenience delivery. When behavior is shifting from buying in bulk to replenishment, which is convenient, which is fast. We see companies in Germany, we see companies in Turkey. And that was a secular trend that's just been accelerated by COVID. We see, we have started investing and looking at alternative payment methods. Outside of PayPal, for example, in the US, not many of these digital wallets have gotten a lot of success. But, with the pandemic, and consumers have been using contactless payment increasingly, I think this is a perfect moment, actually. The merchants have always wanted to experiment with alternative payment method, but consumers had no real reason to experiment on their side. But now, with the confluence of events, we think the environment is ripe for several of these startups, and for example in the mobile-based ACH space, to emerge as winners. So we think this is a very interesting area. As next gen data infrastructure continues to be an area that we see a lot of innovation not necessarily because of the pandemic, but when you think about 10 years ago, what Fortune 500 companies had chief data officers, and you come back today and half of the companies have chief data officers. But data privacy as well is key. And with the pandemic, you had there's a lot of concern with track and trace. So obviously there's been regulatory changes, GDPR. There's also consumers now are much more conscious about their maintaining the privacy of their data. But the COVID has also added some elements to that, and we think like any companies in the data privacy space are very interesting. So these are just a few. Supply chain automation. COVID has disrupted supply chain. The push for lowering dependency on the supply chain, for lowering cost, is going to accelerate. And obviously, I would say one of the areas or the technologies that excites me the most and that permeates everything has to do with the artificial intelligence and machine learning, which you find pretty much everywhere these days.
It's great to know also because, as you know, Kellogg has just launched an MBAI with a focus on artificial intelligence. So let me ask you another thing. You clearly have had a roller coaster through your career, not you personally, but you were at Index during the 2008 Great Recession, 2001 dot-com bubble burst, all very different type of recession from this one, right? And more the recession crisis. Now, although they're very different, is there something in common that help you navigate also this crisis, or every time is new?
Yeah, it's both, actually. I think every time is new, right? You never quite know what to expect. But I think some of the learnings that we've taken from, I think now these three major crises, are that one, you have to keep the course, right? As an investor, you have to continue putting money to work through the dot-com crisis and through the financial crisis, which was very long lasting. So we have to keep looking for the most ambitious entrepreneurs, back them. So keep the course, diversify. So keep diversifying. That means investing across sectors, from consumer to gaming to enterprise. These things go in cycles. The sector is hotter and then gets colder. For example, after the global financial crisis, suddenly fintech and the whole financial area became extremely interesting because of the disruption in banks. So diversify across stages as well, early stage, late stage. So keep diversification at the forefront, I would say, is another learning. And then, act quickly, decisively. I think, especially after the two past crises, this one is a bit different, right? Because this one came out of nowhere with such force. And then the rebound has been nothing but astounding based on the central bank intervention and the government action. It's funny because when you talk about the crisis, actually in our business, it feels that the crisis has ended a long time ago. There's a lot of capital chasing deals. You can see the valuation on the stock market have gone through the roof for a lot of growth companies. But I would say, yes, the learnings have been be decisive to take costs down in your companies when needed, but at the same time, focus on your customers. And our customers are the entrepreneurs, and at the same time, the limited partners that invest in our fund. So the challenge there is to achieve a balance, because you have sometimes in a crisis time, you have to push your entrepreneurs to lower the costs, but at the same time, you have to show that this is the moment to show support and to differentiate.
And actually, this leads very well in, I received a question here that says, I joined a VC firm upon graduation 4.5 years ago to invest out of Fund 1, and we are a first-time GP team. What advice do you have as we try to grow as a firm in every aspect, asset under management, team members, investments, etc.?
Look, it's a very broad question, right? So I'm not
Yes.
sure how to answer it, but success in the venture business is based by being associated with great entrepreneurs and great companies. The first years, several years actually at Index was tough, right? When I joined in 97, I would say until 2004, Index was not a recognized entity. And then it took us many years to be on the map. And what put us on the map initially really was our investment in Skype. And Skype, when it was acquired by eBay, was a landmark deal in Europe. And that's when our brand started to be built. So I would say the primary advice is a couple of things, is really to focus on backing ambitious entrepreneurs and then focusing on the upside, not being too concerned about the downside or companies that may not succeed. Because, in venture capital, what we call the loss ratio is actually not important. When you invest a fund, whether you're going to lose 20% of your capital or 40% or 50% of the capital is not what's going to make the success or the failure of a fund, is whether you have been associated with big winners. So it is diversify, so build large enough portfolios and then back your winners. And once you have a winner, really earn the reference and let them run. And then, and I think success comes from that. Once you have that, you can build your brand and then expand from there. So I would say that that's really the key, and not focusing on growing AUM. I would say that would be the wrong approach.
And actually, there's someone else asking something in a way is related. How do you assess investments in areas like AI and ML? How do individuals determine which companies to invest in? Are we better off investing in sector funds? There's actually 3 questions into one. But
so on the last question, I would say no, you're not better off investing in sector funds. And I have quite strong conviction on that. I would say that you're much better off investing in generalist funds that are going to back companies in various sectors, because you never know what sector is going to pay off or not. Yes, it may look obvious now that machine learning or AI is the right place to invest, but guess what? You can invest in a gaming company like we have in Roblox, and then the company goes public and is worth a ton of money, or you can invest in Airbnb. And so No, sector funds, definitely not. That would not be the approach that I would take. How to assess investments? You have to have expertise. So you have to have people in your staff that have expertise directly, but also have a network which allows them to assess investments. That are familiar with various machine learning technologies, companies that understand the landscape, the competitive landscape. And then there's just like a general element about venture investing, which is assessing the quality of a founding team, their ambition, whether they're hungry, whether they're relentless, their ability to attract top talent. Because the key, probably one of the main key to success of any companies is the ability to attract top talent. It's very difficult for a startup to build a team. And A teams, most often than not, end up in a pretty good place because, even if their original ideas don't work out, they can pivot and they figure out a path. So there is this X factor that, when you meet founders and you interview them and you connect with them, you get a sense that, you're on to people who are able to build amazing teams. And that's really what venture investing is about. So it's both expertise and then this kind of special sauce.
Actually, there's something related, biggest learning picking winners, which is a bit what you were mentioning, but it's also, this is a different person. Have you changed also your approach criteria over time on picking winners?
Yes, I think we have matured in a couple of ways. I think as an organization, as we were getting more confident and had more success behind our belt, I think we became a little bit bolder. And by being bolder, I think what I mean is, as I said before, is really focusing on what if the stars line up, focusing on what could go right rather than what could go wrong. I think that's number one. So, and it's this capability to be able to really focus on the positive, on the upside, is particularly important these days because, as you know, there's a lot of capital in the asset class, and when there's a lot of capital, valuations go up. So, we're faced with a situation where we essentially have to decide how aggressively we pursue opportunities. When you wanted to invest at $30 million valuation, and then suddenly your opportunity is to invest at 70, which happens. At what point do you continue? What point do you give up? So that requires a lot of conviction. So I think focusing on the upside, really being conviction-based investor. I would say that once we build as a team strong conviction, we're quite aggressive at pursuing opportunities despite potentially valuation creep. And then I would say that another areas where we have evolved is in doubling down more aggressively on the companies where we think that there's liftoff, companies that are doing well. I mean, you can see the runway, right? From like all the way at the most successful companies now that are dominating the NASDAQ or even the S&P 500 to, recent IPOs like Palantir and Snowflake. And you look at how much these companies can be worth these days. The upside is very large in this era of digital transformation that we're in. And therefore, once a company starts doing well, you're probably better off doubling down than just kind of riding it and being more aggressive at building positions. So that's another thing that we've learned.
Those are great advices. And in fact, I'm getting so many questions. There's one more here. Any tips for continuing to evaluate companies and founders during the pandemic, where it's primarily virtual?
Look, yes, I don't know what the tip is, right? I mean, to conduct interviews over Zoom. Of course, I think probably one of the things that we've done is more meetings, more people, so more frequent kind of Zoom meetings. But at the end of the day, I can't think of any single investment that we've done to date where we haven't met the founders face to face. So a walk in the park, like it can be like an hour walk in the park just to discuss vision. That has always been part of an important component of our investment making. So 90% or 95% of the evaluation can be done remotely. But for us, we felt today it is still important to make sure that we connect with the entrepreneur. And it's also important in selling our proposition, because most attractive investment opportunities are competitive, and entrepreneurs also have the opportunity to take money from index or someone else. So the ability to connect with them face to face, to have a live conversation, is also important both ways, for them to get to know us and us to get to know them. So I would say my recommendation would be not to skip that step.
Interesting. And talking about exactly the situation, I also wanted to ask you about in terms of indexes, portfolio companies. What do they need most from you now, and what are you proactively seeking to do to help them weather the present situation?
Companies need talent. So I would say the primary request is around talent. Many companies are getting funded. There's extreme competition also to get talented engineers, talented product designers and marketers on board. So our role there is, if it's a very early companies, to help them recruit technical talent, and then a little bit later on is to allow them to help them to identify great talent at the engineering or marketing levels areas, and then to convince people to join the company. So we have a role in identification of talent, a role in helping to select the right individuals to join our portfolio companies, but also then to sell them on why they should join that company versus another one. So I would say that that's clearly number one, is around talent. And then number two, I would say, is more strategic advice. It is about, how aggressively to go to raise another round. And, if you raised $10 million 6 months ago and you have other venture capital firms knocking at your doors and offering you, should you get distracted? Should you raise the money now? Or should you just like put your head down and execute? How aggressively should you expand into new products, into new geographies? How quickly should you expand the cost base and the employee base? So all of these strategic questions, and one that comes up more and more in this environment is precisely the one around fundraising, because capital is available for companies that are doing well, and to choose the right time to get distracted and the right amount to raise is one important one. And I would say then the final one is the perennial one, which is business development, is to open doors with potential customers, and so that will always stay.
And of all the challenges that they face, what keeps you up at night? Maybe nothing.
That they face or that we face?
That the portfolio company face, or maybe you're right, also you as index, you're right, both of them, yes.
I think we face the same challenge, which is an increasingly competitive environment, increasingly competitive world. And it comes from the same source, which is there's broad availability of capital. There are many more players into the asset class. There are larger firms that are coming down because they're looking for growth. Valuations are going up, and they're looking for other areas where they can find hyper growth. There are corporate players playing into venture capital. There are new funds being formed. So there is a lot of money on the sidelines. So that creates an environment for us. If you ask me what keeps me up at night, it's how in this environment can we differentiate our proposition to entrepreneurs to ensure that we will have our fair share of the great opportunities in the future. And for our portfolio companies, it's the same. It's the war for talent, right? In this environment where many companies are getting funded, is how to get the best engineers and marketers to join your company rather than the competition, and retaining top talent, and not having them jump ship once they've vested 3 or 4, like the majority of their stock options, which also has to do with, retention, has to do with compensation, has to do with culture, how to develop the right culture, which is attractive to these employees and keep them in a world where opportunities abound.
Actually, there's a question here. How should an employee at a current VC-backed company evaluate the company's prospect? I guess that's, I don't know if you...
The company prospect, meaning the venture firm's prospect?
Yeah, I guess of the portfolio company, right? If you're working at a VC-backed company, I guess if you...
Oh, so I see. So if you're working at the VC-backed company, how to evaluate your company's prospect? Well, I think to evaluate the company's prospect is actually pretty simple. Is talk to the customers of the company and talk to the venture investors behind the company, and just like have conversations with them. And I think you get a pretty clear read fairly quickly if this is a company that is seen as a winner, that has a strong value proposition, that has a strong and capable team, that has a strong product with product market fit, or whether that isn't the case. So I think these are the two sources, I would say, is customers and backers. And then obviously these days, with everything on the internet, from Glassdoor to product review and Twitter, there's so much information. So I don't think it should be too difficult to get a sense of whether the company has promise or not.
Okay. And I have another question here. It says, what do you view is the most productive way to identify potential investments before you actually make them? For example, is your firm discovers them, or a prospect approaches you, another venture capital firm, an intermediary? How do you go about it?
Yes, I would say that is changing a little bit, but I would say that there are 3 principal vectors, I think, that would point to interesting opportunities. One is, it is referred to you by one of your portfolio companies, and that one is actually probably one of the best ones, which is you someone that you respect, a CTO, a VP engineering of one of your portfolio companies tells you about this great product, where they're an early adopter and they think that it's superior to competition in several dimensions for this or that reason. That would be number 1, is referral from your portfolio companies. I would say number 2 is referral from your wider network, entrepreneurs that you've backed before, which is a great source. Private investors that have invested in your parallel funds before. So people who work at the big tech companies that you have a relationship with. So I would say the wider network referring companies to you, mentioning companies to you, would be number 2. Or when you come across businesses and you check with them whether they've heard of it or not, I mean, that would be a source of qualification. And I would say the third, which is becoming more important as a source of deal flow, is data science, is the ability to follow signals, to pick up, identify companies that are getting traction through a variety of signals and algorithms that you tend to develop yourself.
That's very interesting. Very interesting. I can tell you, I will apologize to everybody in advance because I don't think I can manage to ask all these questions, but let me take you another one. As a venture capitalist, how do you keep learning and improving yourself and grow your team?
This is a ruthless word out there. And the reality is, if you don't keep learning and improving yourself, you're not going to last long. Because entrepreneurs, if your ambition is to back the most ambitious entrepreneur and assist them, help them to build globally successful companies that are going to have an impact on the world, because that is what we're trying to do. Ambitious entrepreneurs building successful global businesses that have an impact on the world. That is our mission. And if you try to do that, these entrepreneurs are extremely demanding. That means that, you always have to be on your A game. You have to understand their value proposition, their technology. You have to understand the competitive landscape. Because if you're not a good sounding board, if you're not a good partner for them, basically either you don't get a chance to invest, or even if you did get the chance to invest, you're going to get a poor reference if you're not a relevant, a value-added investor around the table. And if you get a poor reference, it's going to, seriously curtail your ability to win the next deal. So you have no choice. It's the pressure of the market, which means that, you have to read constantly, you have to talk to a lot of people. So it's pressure from the market that pushes you to improve.
Actually, some of the things you said lead to this is another question, says, as an entrepreneur, seeking venture capital is like dating. What is number one or two things that entrepreneurs should look for? How do you differentiate in marketplace?
I would say it's having a crisp, compelling value proposition that can be, it's the famous elevator pitch. And it's the ability to have, a compelling proposition that comes across in I don't know, 30 seconds, a minute, and then the ability, even if the underlying technology or business model is somewhat complicated, it should be very simple to explain, and it should be engaging because that is also how you're going to attract top talent. And then I would say number two, it has to be fairly obvious why you or your team are relevant to pursue that opportunity, which means that there has to be some relevant background expertise that qualifies you to have a shot at succeeding in pursuing that opportunity. So relevance and crispness of the value proposition.
Something to remember for everybody. Now, I have a lot of questions, but I want to ask you something, given that we have someone from Europe like you talking, just to also talk about, different things. So you're in Europe working for a global firm, right? So what are the most striking differences that you see in terms of how different regions are approaching innovation and entrepreneurship today?
I would say none. That's the striking aspect. Striking aspect is that this is, Index, we're not active in China or Asia, but we're transatlantic. And I would say the transatlantic marketplace in innovation and entrepreneurship is one marketplace. There isn't, of course, the Bay Area, Silicon Valley and the Bay Area will always be a step ahead, right, in terms of the concentration of opportunities, of quality opportunities that are kind of come out of there, just because they have so much going for it, right, in terms of expertise, entrepreneurs, repeat entrepreneurs, amazing institutions. But, innovation emerges everywhere, from Central and Eastern Europe, to even, we even invest in Australia, but I would say, you look at a company that we backed recently, or not that recently, but that recently has emerged as a very successful company on the public market, Farfetch, in the luxury space, is worth about $20 billion, was originated in Portugal. And, Adyen, which is a leading payment company, is from Holland. So it comes from anywhere, and the entrepreneurs are the same. They have the same ambition. Now they have the same, they have access to the same information. They have great technologies, in universities in the US and in Europe. The venture capitalists are now the same. The Sequoia is setting up an office in London. People are flying in from various firms from New York, and the West Coast are flying in and out everywhere, from Budapest to Prague to, and we do the same. We go to New York and we go to LA. Actually, we've made many investments in Los Angeles. I don't see any difference between the West Coast, the East Coast of the US, and many places in Europe.
I guess that's good, with the exception of the competition that then you face. Now, I see another question here. What are, in your opinion, the greatest opportunities in emerging markets for artificial intelligence, Internet of Things, M2M, blockchain, etc.? And what role can development finance institutions, such as the international, the IFC or the World Bank, play a role in enabling these investments?
I don't have a good answer there. I'm sorry. I mean, don't focus on emerging markets. And look, my view on public institutions is what they can do generally is that the best thing that they can do is to create the right environment from a labor law, from a taxation, for the right environment for startups to emerge. Entrepreneurship is there, entrepreneurs from, all parts of the world. So if the conditions are right, good companies or great companies will emerge. I don't think that public institutions should invest necessarily, in funds, or there's enough, in my view, but this is just my opinion, private capital chasing great opportunities. So it's about the environment, education, taxation, legal environment, labor laws.
Yeah, that's a good point. And then there's another one here again. Bernard, do you think biotech is where software was 30 years ago? Is your firm interested in this field?
My firm used to invest in biotech until I think 2011, 2012. Index Ventures had a life sciences team. Then that life sciences team has gone a separate way and created a company, a venture firm called Medici, an Italian name.
Yes.
The founder is Italian, or like the managing partner, if you want, is Italian. So yeah, biotech is a very interesting area. The reason why we stopped doing biotech was that biotech and tech are very different, right? It's different cycle times. Having both in one portfolio is challenging because they need reserve capital at different times. Tech companies. So you have one tech company that within a year and a half explodes and becomes like a major tech company, a major company. You want to put as much money as you can in that business, and meanwhile you have a life sciences company that takes much longer to emerge. So what do? Do you set capital aside for a company that may need it in 3 years' time, or do you invest it now in companies that are, have hit an inflection point? So not having the same kind of cycle time makes it difficult to have them in the same fund. And if they're not in the same fund, then why have them in the same firm? So that was our conclusion, and that's why we stopped doing biotech. And now our life sciences team is able to prosper and attract great talent because they're masters of their own destiny, as opposed to being like in a mixed fund. However, I think we've seen there was, I think, a couple of days ago, an announcement that DeepMind, which is a company that Google acquired, like a artificial intelligence, where they came up with a modeling that allowed them to predict the structure of proteins, which is a technology that could have great applications for medical research. So you can see now how artificial intelligence is merging with biotech and pharmaceutical research, which is very interesting. So I think biopharma, together with machine learning and AI, is a very interesting opportunity. It's not an obvious one to pursue, as an investor such as ourselves, because there's so many other opportunities available for us to invest money, and at the end of the day, our task is to achieve superior returns for our limited partners. So our focus, we've decided to focus exclusively on tech and tech-enabled businesses, to leave life sciences aside.
This is great to hear your way of thinking. I hope it's very useful to everybody here. Now, there are several questions about people who want to enter into venture capital. So let me start by asking you a question about your own career, right? You joined Index when it was a very young firm. What attracted you to that? If I understand, you were coming from Procter and Gamble, right? Very different world. So what attracted you to that environment, and what were some of the biggest growing pains you encountered?
I was actually coming from McKinsey because,
McKinsey,
Francesca,
okay.
there is the world before Kellogg and the world after Kellogg. Before Kellogg, it was Procter and Gamble. After Kellogg, I joined McKinsey.
I see.
I'm an engineer, right? I studied engineering, electrical engineering, and at Procter and Gamble, I was in tech. Believe it or not, who does IT at P&G? But I did. I was a systems analyst, project manager, doing custom-made systems and implementing SAP and a bunch of stuff. And after Kellogg, which, by the way, was one of the best times of my life, a fabulous experience, which is why I'm so pleased to have the opportunity to give back to Kellogg. After Kellogg, I joined McKinsey because, the reason why I joined Kellogg was I wanted to develop soft skills, so it was great organizational behavior and marketing and classes in strategy. And it was a new word for me and it was so interesting. And after that, I wanted to put that into practice. So I decided McKinsey is great, right? Because it's management consultancy. But after a year and a half with McKinsey, I was unsatisfied. I felt disconnected from technology, from entrepreneurship, and I wasn't happy. So I got this opportunity to join someone that I had met socially, Neil Reimer, who is one of the founders of Index, who told me, hey, we're here in Geneva, we're thinking of starting a venture firm. Do you want to join us? And what excited me there was, I think 3 things. 1, people, amazing people in terms of vision and ambition, and the sky's the limit. Second, it was to reconnect with technology. And then the third was just a step into the unknown, right? Which I did find exciting at the time. So that's how actually I made it into venture capital.
That's great. And recently, right, you took a more leadership role in operation, and you left behind the day-to-day investing, fundraising, deal making. What made you decide to take that make the step?
Yes, I think it was Index needed me to take that role, and so it was the right time for me, and it was the right time for Index. As a partnership, we always had one partner focused internally, and the rest of the partners making investments, focused on chasing deals and backing entrepreneurs. And at the time, the person that was doing this job before me, David Reimer, also one of the co-founders, decided to change career and become a history teacher at high school, believe it or not. So at that time, my partners asked me if I could take the role on the operations side to kind of lead the firm internally, take care of investor relations, raising funds, finance, HR, legal. I also manage the investment committee. I help with strategy, and I'm the point person for strategy offsite and making sure that, we keep on track with our objectives. And I did find at the time, it was 8 years ago, that it was a different role, but an interesting role. Is different because investing is full of adrenaline and ups and downs, and your companies are successful or they crash, and whereas this job is much more cerebral, and it's not as visible, but it is very satisfying as well. It's much more kind of long-term thinking, and yeah, it matches my skills of organization, and I did find it very satisfying.
And Exactly. So now there's a lot of people who want advice. So one says, for those of us who have recently graduated or are still in school, what recommendation or tips do you have to find a job in venture capital?
There are not that many jobs in venture capital, right? So I think ideally you have done an internship, your summer internship, you've done it either with a venture firm or with a startup. I think that's a good start. If you've done it with a startup, then you are connected with certain investors that have backed that startup, and you're connected with the venture capital community. So then just use your network, meet people, talk to people. Not necessarily, these are not jobs interviews. These are just coffees or now virtual coffees, I guess, these days, just to get to know the space. And then sometimes this will result into an opportunity. And I think otherwise, I would say that the path is twofold. One is, and if someone is interested in venture capital, it doesn't have to happen today. If the interest is really there, the step could be made in 2 to 3 years. And in between, I would say that the two paths to get there is, one is entrepreneurship or startups or high growth companies. So take a role with a high growth company or with a startup. And then the second one is investing. It doesn't have to be investing in a venture capital firm. It can be investing, in a kind of broader asset management firm, in a hedge fund, or it can also be part of being in a tech investment bank where it's not really directly investing, but it's quite connected to investing. So I would say these would be the path, but my recommendation would be, it's not easy to go straight from graduating to joining venture capital. If I look at the people that we hire today, they come from all places, but a lot of startups, sometimes from other investment firms or investment banks. These would be kind of the main areas that I would focus on.
So that's great, because I have also here a question about how can you transition into venture capital as an experienced corporate professional. So what you're saying is actually that is the way, and it's even easier several years post MBA.
Yes.
Correct. Yeah. Now I have another question instead, given that you were talking about investing in. What do you consider to be the profile of the ideal limited partner which invests in the index ventures?
There are two types of I would say, quote unquote, ideal limited partners. And by the way, if any limited partner is listening to this call, we love you all. So, but I would say one profile which is kind of strategic for fundraising, if you want, is permanent capital, right? These are pension funds. So, and the interest of permanent capital or pension funds is that you're not subject to their own kind of fundraising cycle. So as long as you produce results, you know that they're going to continue backing you and grow with you and support you. So that would be one, which is a permanent capital. The other one is what we call mission-driven investor, which are, for the partners of Index, it is important to have university endowments, foundations, to have healthcare, companies that are active in healthcare as limited partners. And if you look at what we've done in terms of fundraising over the last 10 or 15 years, we've really increased that section, or that proportion of what we call mission-driven investors.
Very interesting. And here there's someone said, at what stage would you recommend that a startup approaches a venture capital firm? Does it make sense to connect before we have any clients?
It can make sense to connect before you have any client, yes. First of all, you have to look at what is the venture firm. Do they invest in seed or pre-seed or not? If they do invest in seed or pre-seed, then there is no stage really, because our mission is to invest from idea, to back companies from idea to IPO. So yes, it's never too early. Obviously, if you have a product, if you have product market fit, you have a wider audience of potential investors. But if you don't, essentially what investors would be relying on is the pitch, as we said before, is how compelling is the value proposition. And second is the background of the team.
And someone else is asking, what advice would you give founders with a strong SaaS product platform, but struggle to find the ideal industry end user market?
So I don't know. I mean, how does one define a strong SaaS platform if they struggle to find the right fit, right? So product market fit is the key. I would say once the product is out, finding product market fit is the number one goal of entrepreneurs before then refining the business model. I don't really have a good answer for that. I mean, you build your platform, you put a prototype out, you have early adopters, and if you're if your platform is delivering real value, then the product market fit will emerge. And if not, then you probably have to go back to the drawing board, change the platform, or do a pivot.
How are venture studios and high service VCs like Unusual Ventures changing the landscape of venture investing?
I don't know how they change the landscape of venture investing. They probably create more opportunities for aspiring entrepreneurs to get going. So I guess they're kind of broadening the base, right, of the pyramid. And yeah, it's kind of affordability for aspiring entrepreneurs, I would say, is what they bring to the table.
I see so many questions, but I want to ask you something about also, what about the culture at Index? What is the culture and what you particularly value and has retained you there?
We made a lot of effort in codifying our values, in having a strong culture that we are proud of. And it is a requirement. Yes, we like having a strong culture, but beyond that, one of the core challenges for Index is we are a transatlantic organization. We have one fund. We don't have like a European fund and a US fund. We have one fund with one team across San Francisco and London on the investment side, and two other offices in Europe. And having a team in San Francisco and a team in London in their own environment, you can see very easily how this could kind of diverge rather than kind of staying closely knit together. So culture is essentially what binds these offices together. Culture is also what allows us to win deals, to attract entrepreneurs, because when entrepreneurs meet the Index partners, they do get a sense of the culture and whether there is a connection, a natural connection that happens for them. So our culture is one that is based on working as a team, that is based on questioning everything, based on being relentless, and being a family, getting to know people within the firm and also the entrepreneurs that we back as people, not just as entrepreneurs or as colleagues, but building genuine, real relationships with people. And we think, we've done a good job at codifying, developing it. It helps us attract top talent. It helps us retain top talent. But we're going to continue investing in it.
And I just also, because people are asking for various advice and other things. Also, because you talked about your switch to leadership, right? So for people who are exactly in a type of job in a VC, how can they decide when they are ready to switch in a leadership role?
I think it's a natural progression, really, and it really should be a pull rather than a push. So I would say basically I don't know if you know that you're ready, but you feel attracted by growing your role. And you know, people who are generally active in venture capital are entrepreneurs themselves. They're risk takers. So when the pool is there, I think you just jump and give it a try.
That's a good idea. And I see another one. How has your MBA at Kellogg helped to accelerate your career, in particular in working with technology company? I mean, you mentioned a little bit what it added you at the time, but if you think of all your career.
I think the MBA gives you broad knowledge base and gives you confidence. And when you invest in startups and you're on the board of companies with ambitious entrepreneurs, and you have to be a relevant sounding board. So to have this knowledge base, this credibility, this confidence, this ability to think in a multifunctional way, I would say is a critical component of success. So yeah, I mean, for me, Kellogg or the MBA has been transformational from that perspective.
And we are running out of time, so I apologize to all the people I haven't answered, but let me get one, which seems to me a good concluding answer. Knowing what you know now, what guidance would you give yourself 5 years into your career as a VC or 10 years in? What, if anything, would you have done differently?
I would say the main one would be bolder. Be bolder. Don't second guess yourself. Don't, be decisive. Don't be concerned about negative consequences. I would say generally it's once you have conviction, commit, don't second guess, be bold. Yeah, that's what I should have done.
I love that answer. I love that answer. It's a perfect Kellogg spirit and a perfect Kellogg conclusion to this conversation. I can tell you from the number of questions coming in, I was struggling to even read and keep up with them, that people really loved your answers and your input and your thoughtful point of view. So thank you, Bernard. It's been really a pleasure, such a privilege to talk to you. I think everybody has been very interested. Thank you so much. And it's great to have you on board to push entrepreneurship and venture capital at Kellogg. Thank you for joining
Francesca.
us.
Thanks for having me. I really enjoyed it.
Thank you. Thank you, everybody. And
Bye.
have everybody, I wish, a health and safety holidays, because we're getting close to them. Yes, thank you. Bye-bye.